let me start the discussion with the component of macroeconomics. Macroeconomics is the branch of economy that studies as a whole of decision making for economy, which is household, firm, government and also foreign sector. So this diagram shows the circular flow of income in two sector economy, which involve the firm and also household. So household own all factor of production and receive factor payment from the firm like wages, and there the household spend all the income to purchase goods and service by making payment to firm. During pandemic COVID-19, the household only allowed just to buy essential items, so they make a payment to the firm to buy goods and service. Firm is a higher factor of production from household by paying factor payment. They sell the good and service to household and receive revenue back in return. The flow of factor production from household to firm and the flow of good and service from firm to household are totally matched. So the firm paying income to household we call Y, while the household paying the firm for consuming good service we call that C. Anissa, can you explain to us about the circular flow of income in a three-sector economy and four-sector economy?
Yes, Kamal. From my comprehension, the circular flow of income in three sectors consists of households, firms, and government sector. The diagram shown here is the circular flow of income in three sectors. The intervention by the government will change the net income through its two activities. The first one is taxes imposed on households and firms, and the second one is government expenditure. Government is one of the sectors that make expenditure, whether on goods or services. The expenditure can raise the net income and known as injection, as it makes the net income in the circular flow increases. When the government imposes the taxation, it is not flown back into the circular flow and makes the net income decreases. Hence, taxes known as a leakage. Next, I will explain about the circular flow of income in four sector. The circular flow of income in four sector is also known as open economy. It involves the foreign sector or international sector, which involve import and export of goods and services. The diagram shown here is the circular flow of income in four sectors. Export is an injection since it makes the net income level increases. As an output is purchased by other countries, we will receive more income and there will be inflows of money in our country. Meanwhile, import indicates the expenditure that is made by our country on foreign countries' output. Import is leakage because the money will flow out of our economy and the net income will decrease.
Now that we have learned about the circular flow of income, we shall move on to the concept of national income. The first concept of national income is gross domestic product or GDP. GDP is a measure of production of goods and services in a country in a given year, no matter by whom the product are produced. As example, a GDP of Malaysia is total income earned by Malaysian resident and foreign resident. However, the Malaysian resident who are working abroad, the total income earned will be excluded in the GDP. The second concept of national income is gross national product or GNP. GNP is a measure of production of goods and services by citizens of a country, no matter wherever in the world they reside. As example, a GNP of Malaysia is total income earned by a Malaysian resident who are working in Malaysia and abroad. However, the foreign residents who are working in Malaysia, the total income earned will be excluded in the GNP.
Next, we will learn about one of the methods of measuring national income, which is income approach. Firstly, we need to understand that the basic premise of the income approach is to add all of the household's income together. So we will add all of the items here in order to get the net domestic product at factor cost. In order to get the net factor income abroad, we will need to add the income of foreign workers who are living domestically. Then we will subtract the income of citizens who are living abroad because their income do not contribute to the domestic production. Then we will get the national income after adding the net domestic product at factor cost with the net factor income abroad. In order to get the personal income, we will add all of the items here with the national income that we get earlier. Lastly, we can get the disposable personal income after deducting the personal income with personal income taxes. Can anyone here help me explain about the other two approaches?
Me Anis, the first approach is expenditure approach. Expenditure approach measure the national income by looking at the GDP from the perspective of total spending of the final goods and services. This is the formula of expenditure approach. Consumption plus investment plus government plus export minus with import. GDP MP equal to C plus I plus G plus X minus with M. GNP MP equal to GDP MP plus net factor income abroad. GNP FC equals to GNP MP plus subsidy minus with indirect taxes. National income equal to GNP FC minus with depreciation. Personal income equals to national income plus with transfer payment minus with corporate income taxes, retained earning, employees provident fund, social security contribution and insurance premium. Disposable personal income equals to personal income minus with personal income tax. Second approach is product and output approach. Under this approach, only value of the final goods and services are included in the calculation. Others' value must be deducted to avoid the double counting. This is the formula of product or output approach. GDP and market price equals to value of final products in the economy. GNP MP equals to GDP MP plus net factor income abroad. GNP FC equals to GNP MP plus subsidy minus with indirect taxes. National income equals to GNP FC minus with depreciation. Personal income equals to national income plus with transfer payment minus with corporate income taxes, retained earning, employees provident funds, social security contribution, insurance premium. Disposable personal income equals to personal income minus with personal income tax.
Thank you for the explanation, Mimi. Now I would like to explain about nominal income versus real income, per capita income, and growth rate. Real income refers to the national income that is measured at a constant price or in a base year. Nominal income is the national income that is measured at a current prices level. Per capita income is the average income per head of population, and the last one is growth rate. Growth rate is the percentage change in quantity of goods and services from one to another. So this is the formula how to calculate GDP deflator, real GDP, per capita income, and growth rate. Next, there are 4 users national income statistic. The first one is the standard of living indicator. It is reflect the individual welfare because it shows how much goods and services that household benefit from. The highest the increase in consumption opportunity, which in turn the increase in standard of living. For example, in Malaysia we have 3 categories of income: B40, N40 and T40. Second is the government planning and policies. National income statistic is a very useful tool for the government to formulate their economic planning. The available statistic of national income can guide the policymaker in planning for the future. Malaysia also use national income statistic to draft the country plan for a 5-year period. That is the sectoral contribution. There are 3 main sectors in economy Malaysia. There are primary sector, secondary sector, and tertiary sector. Lastly, international comparison. With the national income statistic, we can compare the absolute size of the economy relative to another and how well of the average industry in each country.
Sure, Venus. Before the discussion come to the end, I would like to state the problems of measuring the national income. First is the problem of non-monetary sector. These problems usually arise in most of the third world countries. The existence of a large number of non-monetary activities in these countries, especially in the agricultural sector, makes computation of the national income more challenging. This is due to the fact that a large quantity of agricultural output in these countries do not reach the market. Next is underground economy. Official GDP estimates may not take into account the underground economy, in which transactions contributing to production such as illegal trade and tax avoiding activities are not reported, thus causing the GDP to be underestimated. So next is the problem of non-market transactions. A number of product work is carried out in the economy which do not involve payment. For example, in Malaysia, There is a lot of people growing food at the backyard plots, same clothes at home, and any other instances of do-it-yourself goods and services for their own self, families and friends. Hence, no money changes hands, and subsequently no payments are recorded.
So I think that's all for today. Thank you everyone for your participation. Until next time, Assalamualaikum.